Hello everyone, Joffrey Martinez. I am the managing partner at Artefact. I am in charge of the financial sector at Artefact. What is it? It's banking, of course, insurance, payments, fintech, and asset management. And I'm delighted to be with you today to talk about a subject I'm passionate about, which is how AI, GNI, or Gentic are transforming and impacting financial services. I'm also pleased to be joined by Alexis today. Hello, Alexis.
Thank you, Joffrey. So, Alexis Baufine-Ducrocq, partner at Artefact in the financial services team with Joffrey at the Paris office. I am particularly responsible for banks, retail banks, CIB, and private banks, as well as insurers in France. Maybe to start, Joffrey, I think it would be interesting to go back to what's your story in finance and how did we develop this sector at Artefact?
That's a good question. That takes us back a few years ago. My first job, right out of school in private equity at the time of the Eman browser acquisition. So my first step into working life was a bit abrupt, a bit rough. Still, it was my first step into a world that I found extremely fascinating. And why fascinating? Because in the end, it's kind of like, if you ask me, everyone has an opinion, everyone knows about it, and it more or less interests everyone, and everyone likes to complain about what finance does. And why is it that everyone is actually interested in it? In the end, it's a sector that affects everyone's lives, businesses, individuals, everyone. And no matter what you do in life, you are inevitably connected in one way or another to the financial sector. That's the first point. And maybe the second point is that if we slightly caricature what the financial sector is, it's made up of men, women of course, and data. And so the reason why at Artefact I thought it was a really great playground is precisely because data is at the heart of the financial sector. And maybe the last point is that the financial sector is a bit atypical at Artefact because it's actually quite recent. Artefact is a little over 10 years old, and we only launched the financial sector at the end of 2022, beginning of 2023, so it's actually quite new. We first started launching it in France, and then we expanded it internationally as a group.
And how do you explain the fact that the financial sector is so recent at Artefact? Is it a matter of maturity that's a bit different from other industries?
So when we look broadly at the maturity of the sector and its subsectors, I think the first observation we can make is that today, at least as of today, all the players have entered the race for AI, for agentic AI, to capture this value. And why do I call it a race? Because I think there is a real competitive challenge in capturing this value. I'll give a very concrete example. If tomorrow you go to a bank that gives you a loan 3 times faster than its competitor, obviously, assuming the same level of quality, you'll go with the faster one. Same thing for insurance. If your insurance claim is processed 3 times faster for the same price and the same level of service, of course you'll go with that insurer. So there really is a race to capture this value, and it affects all the players in the sector. Now, if we try to look at some comparisons, even though I'm not really a fan of making comparisons between the different segments of the financial sector, we have, I think, a first group, which is mainly retail banking and even insurance, which are activities with high volumes, high volume of clients, high volume of data, high volume of transactions, with strong commercial pressure and strong pressure on margins. These were the ones who moved quite quickly, maybe even the first in the sector on these AI and generative AI topics, because frankly, it was more accessible, especially due to the large volumes involved. That's the first group. Then there's a second group made up of investment banking, private banking, asset managers, and even payments, where AI has historically been present, mainly in areas of expertise among quants, actuaries, and people in charge of fraud detection. So that's quite a historical trend. On the other hand, what's quite recent, and this is pretty interesting, is that AI has moved out of this specialized field more recently, to come back to your question. And now we see it across the entire value chain of these players, whether it's customer relations, credit granting, as I mentioned earlier, risk management, and so on. So ultimately, there are 2 main phases. And in the second phase, there's been a major acceleration of AI in private banking, in asset management, and especially in the sciences.
In insurance, I find it interesting. If we take a step back, insurance is fundamentally a data-driven business. In fact, the actuary is probably the role that most closely resembled a data scientist before the concept of data scientist even appeared on the market. These are people whose core business, the actuary's core business and the core business of insurance, is to statistically model risk and assign it a price. And so what's interesting in insurance is that there is a maturity around data, or at least a strong historical presence of data skills. So we have this first foundational element, which is data expertise. There has been, I think, a very strong acceleration over the past 4 or 5 years regarding customer data, because insurance, especially health and especially P&C, is a business with a lot of churn. So customers leave very quickly. The game is to fill the bathtub faster than it empties. And so we've seen a very strong acceleration. We've observed this with a large number of our clients. When it comes to customer data, mastering and leveraging it to drive acquisition and cross-selling, which greatly secures the client and significantly reduces churn, has been achieved through major foundational projects like CDPs. Many traditional mutual insurers have equipped themselves with CDPs. So we have talent, we have a number of foundational elements in place, and today what we're seeing is a broader acceleration, perhaps at lower layers, with work being done on data platforms. In this area, there are players who historically have a legacy that is very much on premises. Why is that? Because we have highly sensitive data, customer data of course, but also health data. And the various players in the insurance sector are moving towards the cloud. Now, some have announced a full cloud migration in France, which is quite bold given the types of data involved. Most insurers who consult with us today are implementing so-called hybrid multi-cloud data platforms. So they generally operate across 3 environments. One environment that remains on premises, particularly for health data, a cloud environment from GAFAM type providers to access state-of-the-art tools and accelerate AI adoption, and increasingly a third pillar where insurers are considering sovereign clouds like Secnum Cloud to be able to operate across all 3 categories. So we're really seeing an acceleration in building the foundations, and generally with the construction of the data platform, there's also the implementation of true data governance with ownership assigned to business teams. This, as you mentioned, will really allow AI and data, and therefore AI, to move out of the realm of a few experts and become increasingly a driver for accelerating business. That's for France, and I suppose you might be able to broaden the perspective to the international level.
It's always a tricky exercise to compare the major geographic regions. Maybe one way to make it more objective is to look at the revenues generated by AI across major geographic regions in the financial sector. When we look at last year's data, we see the leading group, which is unsurprisingly the United States, accounting for a little over a third of AI-related revenues, with DP leading within the United States. Morgan, which has been the leader for more than 3 years now, at least when it comes to AI-related topics in various rankings. And why are they the leader? Because AI has spread to an extremely large number of processes and is fully integrated into the bank's various workflows. This is true in trading, it's true in private banking, it's true in credit management, and so on. So that's the first group, with the US leading the way. Next, we have a second group, again, not much of a surprise, I think, which is mainly Asia, driven very strongly by China, with an undeniable capacity for innovation and probably one of the best, if not the best, in the world. If I had to name a player, I would mention Ping An, which was historically an insurance company and is now, you could say, a big tech company. They've filed several thousand AI patents, have similarly industrialized a huge number of use cases, and are driving growth in these 2 areas, especially in China, demonstrating this geographic block's real ability to industrialize use cases. Next, we carefully consider Europe, which consistently generates substantial revenues that are actually quite similar in magnitude to those generated by Asia, but with one very significant and crucial difference. Europe places a much greater and more profound emphasis even on ethical considerations and principles. Nevertheless, we have observed that the major European financial players, such as UBS, BNP Paribas, and Santander, to name just a few prominent examples, who have truly and successfully managed to extract significant value from advanced AI technologies on crucial topics such as comprehensive fraud detection, enhanced customer relations management, and especially in the critical area of credit management. Next, a bit lower in terms of revenue, but showing strong growth, we have three regions that are roughly similar: South America, the Middle East, and Africa. Their revenues are roughly similar when looking at last year's data, but the dynamics are different. Latin America is being strongly driven by Brazil, with probably the most advanced financial sectors, in fact, the most advanced financial institutions in terms of fraud management, both among traditional banks and fintechs. For example, Itaú and Nubank are extremely cutting edge when it comes to fraud management. And it's probably one of the places where we'll see the biggest growth in AI over the next 10 years. JP Morgan is projecting an additional 100 billion in revenue just from AI in Brazil, so that's what's coming. Next, we have the Middle East. The topic is very much tied to the priority that different Middle Eastern states are placing on AI. So in fact, the banking and financial sector in the broad sense is ultimately benefiting from these investments. And similarly, just like in Latin America, there's a very strong acceleration. And finally, to wrap up, Africa, where the focus is placed a bit differently, more on financial inclusion. The main challenge is to bank the unbanked and to use new technologies, especially generative AI, to improve this crucial concept of financial inclusion.
And in terms of use cases, do we find families of use cases that are similar across these regions? And if so, how would you describe them?
Yes, there are an infinite number of use cases. I think we all have endless lists of use cases across every part of the sector's value chain. If we try to rationalize and create broad categories, as you said, I see three main categories that emerge, though not very clearly. The first is all the use cases aimed at optimizing costs, cost optimization, to use a bit of financial sector jargon. The second category is about increasing revenue, generating additional growth. The third category, which is more specific to the financial sector, whereas the first two could apply to other sectors as well. The third category is more about protecting these institutions due to their particular status. If we take a few examples from these different categories, the first, cost optimization, is probably where there are the most use cases. Why? Because insurers, and banks in particular, have seen their cost base increase significantly in recent years and are facing more and more challenges from new players. So that's where we see the most use cases. Let me give you a very concrete example. I mentioned earlier the granting of credit. We're working with one of the leading European retail banks where the main challenge is what? It's to reduce by 5 days the time between a request and the granting of a loan. And how do we do that? How does this bank do it? Two things. First, it transforms its processes, changes the way it handles credit approval. And second, it integrates it into key phases of AI, of generative AI, for example, in document analysis, in analyzing your payslips, in integrating the data from your payslip into business applications. And ultimately, in the end, the goal is to reduce the time it takes to grant credit by several days. It's a very concrete example of cost cutting.
It's interesting because you translate cost cutting as reducing delays, and actually we see that a lot. We see this a lot because turnaround time is a very powerful indicator of service quality, I think, across all financial services. If we take a very emblematic use case that we see among a number of insurance players, which generates efficiency gains in terms of cost cutting, but which from the client's perspective mainly translates into shorter turnaround times, it's claims processing. Many insurers are investing heavily in AI solutions, generative AI, and even agentic AI to automatically process claims from end to end, starting with simple claims and increasingly more complex ones as well. Let me give you an example: a health insurance claim. Several insurers now offer processes where you can submit a health invoice, like your dentist's bill, for instance. This invoice is then analyzed by an OCR system, for example, which will detect the type of treatment and identify the practitioner through their identification number. After that, there will be an initial level of processing to determine, for example, what will be reimbursed by Social Security. We have an AI that will apply the Social Security reimbursement scale, then, using that data, check the client's contract to determine their level of coverage and apply that coverage to the remaining amount owed. It will then calculate the client's final out-of-pocket expense and finally issue a reimbursement. And here we have players who are able to fully automate from end to end and within just a few minutes the processing of claims for 20 to 30% of their P&C and health insurance claims with operations that are sequential and sometimes complex. There's also the ability for a human to take over the process if the AI Celia detect encounters too much uncertainty to continue on its own. This results in processing times that can be almost instantaneous, especially with instant transfers. So a refund is issued to the client's account. And in terms of service quality, that's really extremely powerful. So here AI allows us to make gains on two fronts. Obviously, there's the cost to serve, but also the quality of service. What's interesting is to look at how these gains are reallocated, because in fact, it also allows us to benefit in another way, which is that with this, I can assign people to tasks that require a human touch. And so spend more quality time on cases that are more complex. Do we also have cases where AI is used to drive growth?
Yes, absolutely. Let me just go back for a moment, because what you said about cost to serve is really interesting. You're right, we do save time and we can reposition people. It's kind of an interesting paradox. We save time, we automate, but we put people where they add the most value. That's very true when it comes to complex cases, you're right. That's also very true in credit granting, which are ultimately processes that can sometimes be a bit anxiety-inducing, a bit stressful. We're talking about life moments, we're talking about difficulties. So the human role is fundamental, and I think that here technology ultimately becomes an enabler for the expertise we can bring to different processes. And sorry, you're right, the topic now of how AI can significantly help to boost overall growth and generate substantial additional growth. I think one of the recurring topics is how AI improves the customer relationship. If we take a step back and set technology aside for a moment, what makes a good customer relationship, if I stick with the example of banking? A good customer relationship is a bank that works. What does a bank that works mean if we stick to retail banking? It's a bank that is able to follow up with you when needed, and not the other way around. To use a bit of financial sector jargon, it's not the client who is the middleman for the bank, but rather the opposite. So a bank that works is a bank that is reachable. That is, when I need to contact it, it's available, and it's a bank that is knowledgeable. If I have a somewhat technical question, I want to get an answer. At the end of 2022, beginning of 2023, what happened? ChatGPT became widely accessible, so it set a new standard for customer relations. Everyone tries out ChatGPT, everyone sees its capabilities, its ability to respond instantly and with incredible accuracy. And so in the end, it sets a standard, it sets a new standard for customer relations. And everyone tests it outside of the financial sector. We expect it to be the same in banking. And in a sector like retail banking, where products and services are increasingly becoming commodities, having excellent customer relations is a real differentiating factor. And what do we mean by that? What is an excellent customer relationship? It's a customer relationship that is available, reachable, that works, that can offer you personalized services, that can respond to any request, and so on. And here, of course, all these use cases are driven by AI and by Gen AI in particular.
He's showing me the transition. In support of growth, we've also heard quite a bit about two major families of use cases: AI augmented marketing for better targeting, and so on. The AI augmented salesperson, capable of having real-time sales pitches, etc., to help improve their sales performance. I think there's a very interesting area of use cases that I'd like to highlight here. It's the ability that AI offers to build new, higher value-added services, which without AI would actually fall into a cost bracket that would be unsustainable. And here, for example, I'm thinking of private banking. In private banking, you have highly specialized roles who constantly monitor the markets, study securities, and try to predict how these securities will behave, producing analyses intended for other expert professionals so that fund managers and portfolio managers can make informed decisions. The problem with these analyses is that they are highly specialized, and the analysis reports they produce are not very readable for the client. Yet in private banking, some clients manage their own investments and portfolios. And so what they expect from a private bank is advice. They want to be able to get good advice so they can make well-informed transactions themselves, based on their own decisions. However, there is a characteristic of financial markets. Once analyses are made, they tend to be self-fulfilling. That is to say, if everyone decides that this stock is no longer worth 2,000 but should be worth 2,400, the market will quickly adjust. So there is a major challenge in reducing the time between the financial analyst's insights and the execution of the transaction by the client when the client is the one making the decision. And that has enormous value for the client. So today, there are a number of private banks working to shorten this gap between expertise and the client, even though this delay is structurally rather built in. Since there is this center of expertise, it then trickles down to portfolio managers, to relationship managers, that is, private bankers, who will themselves take the time to call or contact their clients. It can take 2 or 3 days today between the analyst and the client contact. Today, what the IAGN does very well is take a complicated document, extract its essential substance, and turn it into directly actionable advice. And I think that has a lot of value for the client and also for the bank, since it will generate transactions as a result. Receiving this intraday information and information that is immediately readable and actionable for a client who, even if they are familiar with financial issues since he manages his own portfolio, he knows how to do it. However, he still needs arguments presented at a level he can understand in order to make his decisions. And this is exactly the kind of service that generates both quality and revenue.
We talked about 4 use cases related to cost management, and we talked about 4 use cases related to growth improvement. Now, as I mentioned earlier, there are also 4 use cases related to protection. One area where AI works very well is in detecting rare events. And what does that include? It can include anti-money laundering efforts, but also fraud detection. Here, AI works extremely well. So concretely, what is at stake and what is the challenge? Just to explain a little, with fraud, you have to be able to analyze a huge volume of data in real time and be able to adapt to fraud patterns that evolve very quickly. Fraudsters are obviously clever, and it's a kind of endless race between the cop and the thief, so you always have to stay one step ahead, at least if you're the cop chasing the thief. We've worked a lot on these topics and how it works in practice. We actually model complex fraud patterns by meticulously integrating both comprehensive customer data and detailed transaction data. This sophisticated approach means we'll thoroughly check if, for instance, I haven't changed my residential address an excessive number of times within the relatively recent past 6 months, or if I haven't attempted to log in from highly unusual or suspicious geographical locations within a very brief and concentrated period of time. With the careful analysis of all this extensive and valuable data, we are able to accurately model intricate fraud patterns and subsequently block suspicious transactions promptly and effectively when we strongly suspect fraudulent activity is occurring. The challenge is, obviously we can't block everything. If every time you pay you're blocked, there will be zero fraud, but there will be a real user experience issue. So the whole challenge is to find the right balance with an added technical difficulty. When we talk about fraud, we're dealing with what are called imbalanced data. What is imbalanced data? It means that, fortunately, there are far more non-fraudulent transactions than fraudulent ones. So actually, being able to identify fraud patterns within such data that are imbalanced requires real technical expertise, especially in handling models. So that's a very concrete example of protection.
So you mentioned fraud, and indeed, when it comes to protection, there are 2 main categories: fraud and compliance. And in fact, there is a set of use cases that is common to all players in the financial services sector, which is the fight against money laundering and the financing of terrorism. This is a huge issue since all transactions are actually screened by a set of rules that just keeps growing. Rules involving countries under embargo, under sanctions, individuals under sanctions, and so on. These rules are updated very regularly. The reference lists within these rules, that is, the names of the individuals concerned, etc., change significantly over time. The problem is, if we apply 100% of all these rules using only rule-based models, we end up generating a huge number of false positives. And handling these false positives, up until now, until quite recently, was a manual task, as I've seen in banking back offices. It's a thankless manual job that basically involves checking transactions one by one, thousands of transactions one by one. This can keep hundreds of people busy in large international banks, all just to realize that this payment flagged as sensitive because it contains the word Tehran is actually just going to a company located on Rue de Téhéran in the 9th district. And so this is where the combination of AI and rule-based approaches will drastically reduce the scope of false positives and allow investigative efforts to focus on cases that are more likely to be actual fraud. So here the whole challenge is to provide a powerful enough filter to truly improve efficiency, and it works. We have clients who achieve up to 2 orders of magnitude in improvement. They reduce the number of alerts to process by almost 100-fold while still being extremely effective at not letting any slip through. And we make sure it's a modeling job that's never truly finished. In reality, I think there are entire teams working continuously to optimize these models.
A whole range of use cases. We just talked about them. Now, the real question behind all this is, does it actually work? What are the real ROIs? And what does it actually take to achieve those ROIs?
Quite simply, yes, it works when we're able to build them. And I think that the teams at our clients' companies have become highly professionalized through factory-type setups. They've moved past the whole POC concept, or at least have really limited it to genuine research and experimentation topics, and have shifted to industrial scale approaches that actually make things work. What is the ROI? On that point, it varies greatly from one use case to another, but it can be extremely powerful. We were talking about fraud. When you reduce alerts by a factor of 100, I have clients for whom this has helped cut operational costs by, we're talking tens of millions. So it pretty much pays for the use case itself. The ROI is very quick. For other more operational use cases, for process automation, it obviously depends on the base to which it's applied, but you can achieve gains of 20–30% efficiency on activities on end-to-end processes. So the ROI is there, and it can be significant depending on the volume of activities, of course. But I would like to urge a fair amount of caution regarding this notion of ROI, or at least to take a step back. I think it's reductive to view AI as just an automation tool that will save a few minutes or even a few hours here and there. I think AI is something much more transformative than simply a new automation lever, like RPA or others were in their time. Like RPA or others. It's much more transformative, and I think, for example, if I take the insurance sector, the vision of an insurance manager of the future is not just someone who no longer has to re-enter the client's bank details when they change them. It's not just a manager it's not just someone who sends an email suggested by the AI. It's a manager who, for 20–30% of their time, will supervise agents who themselves handle 60–70–80% of simple claims, and who will devote the rest of their time to more complex human situations, claims that require it, and so on. And that's much more transformative. The danger, I think, is to have a somewhat accounting-driven approach, or only an accounting-driven one. With ROI, you end up with little bits of automation here and there, when in fact there's significant potential for transformation in these professions, not just to bring 10 or 15% more efficiency in one area, but to achieve a real qualitative leap and a transformation of activities. And I think that promoting a vision like this also has a better chance of succeeding, because I believe it's much more engaging for the teams in the end. Going to map out processes with teams just to ask them where we can gain 10% efficiency, essentially to cut 10% from the teams, is a difficult approach to take. It's not very motivating. Whereas I think that telling them what can we get rid of to better serve the client, to do more for the client, in that context, especially in management services, people want to help the client. So promoting a vision like this, I believe, engages the teams more.
I can only agree with the vision of transforming professions through AI. Then there is
another topic when it comes to ROI, and that's AI for everyone. In fact, in our clients' AI strategies, and I suppose it's the same for your clients, we often see 2 main areas. There's AI that transforms, and then there's AI that we make available to all teams. to generate what we often call diffuse productivity. Why? Because we're going to save a few minutes on a number of tasks, and also because everyone can use it in the way they see fit and find most useful. In response to this, many of our clients over the past 6 to 8 months have tried to measure the ROI of this diffuse productivity by tracking people, like you save 10 minutes on your reports thanks to Copilot and so on. Because you have to justify expenses with invoices. The reality of this approach is that, in my view, we're not actually putting real money against that invoice. We're just putting Excel money, meaning that the 10 minutes you save when preparing for your meeting thanks to our internal tool, you'll never actually see them show up in the P&L. And that's okay. I think we need to let go of the idea of measuring diffuse productivity gains from AI. However, that doesn't mean it has no value. The value it brings is that it raises and standardizes quality at a higher level. This will also give rise to AI champions within each team, people who will realize that certain ways of using AI are particularly useful for their team. So to capture that value, what you need to do is foster excitement around these AI champions, unleash creativity, and let them shine. And all of this for what purpose? Ultimately, it's to drive adoption. And that's when we'll create value, and a value that will be reflected in better adoption of transformative AI products, since people will have become familiar with them. They'll be accustomed to using these solutions, which are non-deterministic and differ somewhat from what they're used to. This whole dynamic around AI brings about new risks that financial services need to address. But risk management isn't new in this sector, is it?
No, not at all. Actually, you're right. The first risk isn't new, but I think the primary risk is simply the risk of not taking action. Obviously, the risk of not getting involved. I think that's the biggest risk of all. But you're right, it's not new at all in this sector. We shouldn't forget that the primary job of the financial sector, especially banks and insurers, is risk management. That's their core business. So, robust IT resilience, stringent banking secrecy, and absolute data confidentiality are truly at the very heart of these critical sectors. On the other hand, what has changed a bit, what's new, what AI has brought as a new topic is that indeed there's a heightened vigilance, a higher level of requirements. That's the first point. And secondly, the regulator is paying more and more attention to these issues. And this is clearly reflected in particular through comprehensive regulations concerning data access, data privacy, and robust cyber resilience measures. Organizations, for example, when creating a model, a very concrete example, a bank, when a model is created that will be used to make decisions, the person who creates it is not the same person who validates it. The one who validates it is the second line of defense, and it's not necessarily the same people who review it again, which is the third line of defense. On top of that, there may also be a review by the regulator. These are not new things at all. In the financial sector, in the broad sense, it's absolutely not new in the sector.
Our clients are organizing themselves to address these risks. They have structured themselves in terms of foundation, as we saw earlier. For you, what would be the outlook now for financial services?
Well, I think the first point, it's always hard to see into the crystal ball, but the first point is to keep executing on the roadmaps. To put in place the enablers you mentioned earlier, develop use cases and go after value. To continue what has already been started. In any case, that's the first point. The second point I would highlight is, of course, how can you not be excited when you see how fast things are moving with agentic technology? Naturally, it speeds things up. It accelerates the topics. And how does it speed them up? You mentioned it earlier. We have topics related to diffuse productivity, and that's working very well. We have topics around process transformation, as we discussed, and agentic technology is a huge help with that. And what I think will change the most is the way we work. It's going to completely reshape the ways we work. You mentioned it earlier in the context of insurance, but it applies to all players in the financial sector. If I were to draw a historical parallel between the years 1850 and 1880, in the bustling world of banks, there were indeed vast armies, mostly junior employees, admittedly, who would meticulously add up financial sums by hand on very large, extensive scrolls. And that kept a huge number of people busy. In 1890, I can't remember the exact date, the mechanical calculator arrived. Did all those people disappear and get laid off? Not at all. Their jobs were completely transformed. What did they do with the time they saved? They used it for financial analysis, risk analysis, and making forecasts. So the job changed. So what I anticipate is pretty much the same thing. That is to say, the job is going to change a lot. Probably more focus on supervision, especially of agents. And also probably more focus on transformation, as we touched on earlier in our discussion of processes. So an incredibly important and valuable skill to possess is the crucial ability to effectively transform existing processes. So those are, broadly speaking, some of the perspectives I imagine.
Thank you very much, Jeffrey, and thank you all for joining us. I hope these insights will be valuable and useful to you, and we'd be delighted to explore them further with each of you.
Thank you very much.